Okay, just as a refresher of what we've been doing so far, I need you to think about this. Learning objective one and learning objective two, that's supposed to be a no there, was really all about analyzing transactions. We spent an enormous amount of time learning how to analyze events to see if they affected a company financially as they happened. If so, what accounts were affected? And if so, were they affected because we have more of it or less of it? And then you learned how to read the sides of an account, the debit side and the credit side. And so now you could apply the debit and credit analysis to all of that. This was a large part of everything we did last week. It was super important. When we met briefly on Monday, it was to introduce the journal. It was introduced to journal. The journal is the very, very first place we write this stuff down. All this analysis is just that analysis. It actually starts here in the journal, but we have to do all that analysis before we can actually write anything in the journal. And so we write the transactions out by date, the account that's affected, and the first account is affected on the debit side. The second account listed is affected on the credit side. So what we're going to do is, and this was learning objective three right here, LO3. Today we're going to focus on what happens to those numbers after we put them in the journal, and that's basically they travel into something called a general ledger. So you're going to be learning a lot about this today. But again, lots of analysis has to get done before this process gets started. Okay. And we did the journal last time, indicating for uh, every entry in the journal is by date because it's chronological. The first account listed for each transaction is the account that was affected on its debit side. There's a little bit of an indent. The second account that's listed is the one that's affected on its credit side. And that's true for every single transaction that we were able to journal. Okay. So what happens now that we put all these numbers in the journal? What happens to these numbers? That's basically what we're going to be looking at in objective four, and that is they post to a large book called a ledger. So, well, back in the day, it was a very, very large book. Now it's a computerized book. If you printed it out, it would be enormously large. So basically, the ledger is a very, very large group showing all of a large book showing all of the accounts of the company. And each account is listed separately in the ledger. The ledger has a certain order, just like your book. A textbook has a certain order, right? You open the book, it starts with page, chapter one, it starts with chapter two, then chapter three, etc. Well, if you were to literally open up an old time ledger, the very first set of accounts you would come to look at are the asset accounts, and they would be listed in the order you would see them on the balance sheet. So the very, very first account in the ledger would be the cash account, and only what happened in the cash account would be reflected there in that part of the ledger. So the ledger does give each individual account its own section, and you see everything that's happened in that account. So again, it's set up very much like the order of a black balance sheet. Cash would be the very first account listed, and then the other current assets would be have their own separate section. Then we would move on to property, plant, and equipment accounts, et cetera. Whatever accounts they had, you would see them. After the asset accounts are listed, then the next set of accounts you would see in the ledger would be the liability accounts. Again, listed in the order you would see them on the classified balance sheet. So you would definitely see the notes payable section looking at you first, and anything that happened in notes payable would be shown right there. Then the accounts payable section would be there with anything that happened in the accounts payable would show there, etc. all the way down. And then the last set of accounts you would see are actually broken into a few things. First, your general accounts that you're used to seeing in stockholders' equity, like common stock and retained earnings. In the ledger, the dividends account is listed right after the retained earnings account in the ledger. After that, technically, your revenue accounts, in this case, our company is very small, it only has one revenue account, would be listed. And then very, very much the last things that would be listed are individual expense accounts. Okay. So this is how the ledger is organized in essence. The ledger is also created because every time you start a business, you need a chart of accounts. Okay. And a chart of accounts basically is, all right, you started a business, terrific. What accounts do you need? Because as transactions happen, you have to record the transactions, right? That's what accounting is. But in order to record a transaction and do accounting, you need to know what accounts you have. So a chart of accounts is simply the list of accounts that a company, in this case, Sierra Corporation, is starting with. They have the following asset accounts. They have the following liability accounts, stockholders' equity accounts, revenue and expense accounts that are listed here. This listing, each one of these accounts would have its own separate section in the ledger. So when you open up the ledger, the very, very first account you would see is the cash account, and anything that happened to the cash account would be listed there if you opened up the ledger for Sierra Corporation. Then after all the cash data is there, the next section would be whatever happened to the accounts receivable account would be listed there. So you can see that. Then when the accounts receivable account ends, the next account you would see is supplies, and anything that happened to the supplies account for that company would be listed right there. And it would simply go in order, assets first, liabilities, all these would have its own specific section all the way down. So that's basically what this means. What we're going to be doing is the act of transferring things from the journal to the ledger is called posting. And that's basically what this part of the chapter is, this objective is focused on, is posting. So how does it work? Well, let's take a look at our journal. Remember, when Sierra Corporation started, the owners put $10,000 of cash in exchange for common stock. And so we debited the cash account for 10,000 and we credited common stock for 10,000 in the journal. That would be the journal entry. Okay. Well, now that the journal entry is done, what happens to these numbers? Well, they would be posted to their individual areas in the ledger. So when you open a ledger, the first account would be the cash account. So clearly, any journal entry that affects cash, whether it's being debited or credited, would need to be transferred into its account in the ledger. So in this case, you see the $10,000 debit to cash being transferred from the journal into its specific account in the ledger, showing that it's a debit of 10,000 to cash. It's from the fact that we did it on October the 1st, and it was because we issued stock. Something that came up in last class is, what is this reference column for? You're not really going to see the reference column on any of your homework assignments, but what it does is it provides us with literally a reference, a checkpoint. So for example, this shows a reference of J1. But what does that mean? Well, J is the journal, page 1. So J1 is simply the journal, page 1, showing that this is where this particular transaction came from. Okay. If you also notice too, in the journal, the cash account is referenced as 101. Why is that? Well, because all the different accounts have their specific account numbers. And so in this case, the cash account is account number 101. Common stock will have its own account number, and this credit would need to be posted into the common stock portion of the ledger in the common stock account. And of course, they would have a reference there as well. But for our purposes, we're not worried so much about the references because we're not going to really see them on our homework. We are worried and focused on transferring the data from the journal into the specific account in the ledger. So you'll see how this is done. Okay. So this is the entire recording process of all 11 events that were introduced to you in Learning Objective 1. Okay, it keeps going back to that. So look at all the stuff that we learned in Learning Objective 1 and 2. Okay, we read an event, we did some basic analysis, we had to put it in the equation to show more cash, in this case, more common stock. Then we had to do a debit and credit analysis. Well, what does more cash mean? Well, that means that this $10,000 would be on the debit side of the cash account. This $10,000 would be on the credit side of the common stock account. And then we wrote it in the journal. Okay, so Learning Objective 1 and 2 up here, Learning Objective 3 here. Learning Objective 4 is now that we put it in the journal, we have to transfer the number into its specific account in the ledger. Now here it looks like these are just two side-by-side accounts, but this is sort of like two separate pages. It's almost like if you kind of ripped a page out and you put it side by side on the slide. There's only so much room on the slide, so it's literally two separate parts of the ledger, but they look side by side. Notice too that all these accounts resemble the letter T. Because in essence, an account has two sides. So there's a title on the front of the account on the top of it. The left side of the T is the debit side. The right side of the T is the credit side. So in essence, they call it a T account simply because it has two sides. And when you put it like this, it looks like a T. This $10,000 debit to cash in the journal needs to be posted to the debit side of the cash account. That's posting. The same thing, this $10,000 credit to common stock needs to be transferred, posted to the credit side of the common stock account. Remember, here's common stock, it's got two sides. All accounts have two sides. We're just putting the number from the journal based on the column it's in, debit or credit column, into the proper side of each account. That's posting. We're going to review the whole thing, so hang in there. Event number 2, we borrowed money from the bank. We did a whole bunch of analysis in Learning Objective 1 and 2, right? We had to decide, okay, more cash, more notes payable. How do we say that in debit and credit terms, etc. Once you figure that out, now you know how to do the journal. You simply have already figured everything out, so you're simply writing it down. So on October the 1st, we have a debit of $5,000 to cash, a credit of $5,000 to notes payable. Boom, we're done. What happens to the numbers after that? Well, we have to post them into the specific accounts in the ledger. So this $5,000 debit to cash needs to be shown as a $5,000 debit to the cash account in the ledger. It doesn't negate the previous event. That money's already there. We're simply basically putting another debit into the account, which in essence means we're adding money to the account. Okay, but again, it's two separate entries. Here we have a $5,000 credit to notes payable. Again, these are separate pages in the ledger. I'm sort of making a ripping sound here. In the notes payable section of the ledger, you'll see that this is supposed to be on the credit side. So from October the 1st, the credit of 5,000 shows more notes payable in the ledger as well. Event number 3, we bought equipment with cash. Lots of analysis that we had to do. Okay, more equipment, less cash. More equipment is debit, less cash is credit. Okay, now we write it in the journal as a debit to equipment for $5,000, a credit to cash for $5,000. That's The whole process, right there. So after that, we have to post it in the journal. Again, these are separate pages in a very large book. At least back in the day, it was a very large book. Now it's an electronic one. So here we have a debit to equipment. So the equipment account has a $5,000 debit. So for October the 2nd, that $5,000 debit shows up in the equipment account in the ledger. Notice that the cash account in this case is credited. So we have to move this $5,000 and post it on the credit side of the cash account. Remember, there's two sides to every account. This goes on the credit side of the cash account. So one thing that happens very often is you'll be asked what the balance of an account is. So here, cash is very, very busy because we had 3 entries in cash, $15,000 on the debit side, $5,000 on the credit side. So what is the balance in the cash account? Well, the balance in the cash account, we would say, is a $10,000 debit balance. Notice it has to be on one side or another. You can't have a balance in the middle. It's either going to be on one side or another. So again, cash, because it's an asset, has a normal balance on the debit side because that's the greater side. Okay, this is where we increase it. So that's where its normal balance will be. So if you were asked what's the balance in cash, the correct answer would be there's a $10,000 debit balance in cash. Okay, after this event. The fourth event here, we received money from a client. It was a cash advance. So a cash advance means we owe this client tours. So we thought about it. We have more cash, more unearned service revenue. More cash happens on the debit side of the account. Unearned service revenue is a liability. Liabilities increase on the right side or the credit side. So we did our journal entry, debit of $1,200 to cash, credit of $1,200 to unearned service revenue. Then we have to post it in their respective accounts in the ledger. Again, very large book where many different accounts are listed. So this $1,200 debit to cash is going to be listed in its own entry, October the 2nd, $1,200 debit. Again, we have a $1,200 credit to unearned service revenue also on October 2nd, but that is on the credit side of that account. So what would be the balance in the cash account now? Well, the balance in the cash account would be $11,200 debit balance, okay? Because the debit side is larger than the credit side by $11,200. Knowing how to do a balance is important. And event number 5, they received $10,000 from doing work, right? Guided services performed. We thought about that. We said, okay, we got a whole bunch more cash because we performed work. That's service revenue. Okay, cash increases on the debit side, service revenue increases on the credit side. And so we put it in the journal, right? This is the first place accounting really starts in terms of that collection process. October the 3rd, debit to cash of $10,000, credit to service revenue of $10,000. Now, what happens next? We got to post it in their accounts in the ledger. So this $10,000 debit is going to be posted on the debit side of the cash account because that's where it is here. So it's going to be here. The $10,000 credit in service revenue is going to be posted on the credit side of the service revenue account. Okay, remember, all accounts have two sides. We're just making sure if it's in the credit column here, it's going to be in the credit column in the account in the ledger. The 6th event, we paid rent. We did some analysis here. Rent, any type of expense reduces stockholders' equity. And of course, we have less cash. So we did our debit and credit analysis. And here we learned that expenses are going to be debit. So rent expense will have a debit of that $900. Cash is lowered. So that happens on the credit side of the cash account. So then we put the journal entry into place. On October the 3rd, we had a debit to rent expense, a credit to cash. What happens after that? These numbers move to their respective accounts in the ledger. which basically is here, this $900 debit to rent expense shows up on the debit side of the rent expense account. Remember, all accounts have those two sides, debit and credit side. So if it's in the debit column here, it's going to be on the debit side of the account. This $900 credit to cash needs to show up here. Okay. Cash, again, also has two sides to an account. This is on the credit side here. So again, when you add up all your debits and take away all your credits, you're going to get a debit balance. The debit side is going to be much larger than the credit side in the cash account. The seventh event, we paid $600 for insurance. We analyze this a lot. We have more insurance. We call that prepaid insurance. It's an asset because when we buy it, we're not using it that whole day. We bought a whole year of insurance. That's our asset, and we spent cash to buy it, so we have less cash. So we debited our prepaid insurance, credited our cash. That's what we wrote down in our journal entry on the 4th of October. Debit prepaid insurance, credit cash. We simply move those, right, posting them to their respective accounts in the ledger. This debit to prepaid insurance will show up on the debit side of prepaid insurance. This credit for cash is going to show up on the credit side of cash. The 8th event occurred here where we bought supplies on account. So we got a whole bunch more supplies, but now we have an account to pay, which is an accounts payable. We said, okay, supplies increases on the debit side, accounts payable increases on the credit side. So we did our journal entry on the 5th of October, a debit to supplies of $2,500, a credit to accounts payable of $2,500. What happens next? We post them in their accounts. The supplies account has a debit of $2,500 from the journal, needs to be put into the supplies account in the ledger. This $2,500 credit to accounts payable needs to be put into its account in the ledger. Okay. Event number 9 is an event. Anytime you hire someone, interview someone, whatever, it's not a financial event. It's not. It will be when you pay them, but not right away. So there's no accounting to get done. Event number 10, looks like we paid a dividend. Did a lot of analysis on this dividend thing, right? We have dividends take away from, right? We subtract dividends out of retained earnings on the retained earnings statement. So less retained earnings, dividends means less retained earnings, less stockholders' equity. And of course, we use cash, so less cash, which means less assets, right? So dividends are on the debit side in this case because they shrink retained earnings. Cash is going to be affected on the credit side because we have less cash. So we put it in the journal on the 20th of October. We have a debit of $500 to dividends and a credit of $500 to cash. Once we do that, we move those or post those to their accounts in the ledger, that very large book. We flip to the dividends account. There's nothing there. This $500 on the 20th is going to show up on its debit side. This $500 to cash is on the credit side. So you're going to show it here. Okay. And the last event we did, we paid those salaries, $4,000 in salaries here. We analyzed this. We said, okay, a salaries and wages expense. Remember, expenses take away from that profit that we have. So in essence, to reduce stockholders' equity, expenses are on the debit side, and we have less cash. So we debit the expense and we credit cash. So here we wrote it down in our journal for the 26th of October. Salaries and wages expense got the debit, cash got the credit. What happens after that? We post them into their specific accounts. Salaries and wages expense account shows the debit on $4,000 here on the debit side of the account. The $4,000 credit to cash shows up here on the cash, the credit side of the cash account. The thing is that this is the last event. We're going to need to know what the balance is for all these accounts. Cash is the busiest account, so it has the most going on. And basically, you're adding up all your debits, correct? And you're taking away all your credits to find out what the balance will be. Okay, the balance will be a debit balance, and I think it's about 15,200 or something like that. We'll find out in a moment. So this is what the journal looks like out of everything that we did for Sierra Corporation. Each and every transaction is listed here in the journal all the way through the month of October. And then all you did is post all of it to the general ledger. So again, each of these, even though they're listed all on one slide, they're all separate. Think of them as separate chapters in a book. They have their own little section in this large book called the ledger. So when you look at the cash account, it's the busiest account, right? It had 4 debits were transferred from the ledger, from the journal into this ledger account. And there were 5 different credits that were posted from the journal into this ledger account. But when you add up your debits and credits for, so take away your credits for cash, cash had a debit balance of $15,200. And that's important to know how to do, how to calculate balances in these accounts. Cash is an asset account, increases on the debit side, balance is going to be on the debit side. Supplies, prepaid insurance and equipment, also assets, but only one thing happened. So that was also the balance. And notice the balances are all on the debit side of these accounts because these are asset accounts. Asset accounts have balances on the debit side. Payables are next. Notes payable is a liability. Accounts payable is a liability. Unearned service revenue is a liability. Notice that they also were affected, but they were all affected on their credit side because for liabilities, we show more liabilities on their credit side. So all of these are balances, credit balances in the liability accounts because we have those liabilities on our books. Common stock, as you know, stockholders' equity account also has a balance on the credit side. Dividends takes away from stockholders' equity, its balance is on the debit side. Service revenue is where the profits are. All of its balances will show on the credit side. And then each individual expense account will show its balances on the debit side. Okay. And this basically is the summary of all of the stuff that we posted from Sierra Corporation on those 11 different events that were journalized. Your book also gives you a do-it exercise by giving you a journal up front and asking you to post into this sort of makeshift ledger. So I'll do a few of them with you here. Again, I'm not really the best at writing with my finger here, but I will show you how I would approach it. So the dates are important as well as the amounts, right? And again, if it's on the debit side here, it's going to be on the debit side of the account when we post it. If it's on the credit side, it'll be on the credit side of the account. So here we have July the 1st, cash has a $30,000 debit. So when I go down, this is the cash account and my date is 7/1. So that's going to be my date. And then I'm going to write in as best I can with my finger the $30,000 on the debit side because that's on the debit side here. It's going to be on the debit side there. This common stock entry is on the credit side. So I'll go to common stock. Again, it's important to put the date is 7/1. And we have $30,000 credit to common stock posted here as well. So basically I'm done posting my July 1st stuff. On the 9th of July, I have a debit to accounts receivable. So my accounts receivable is an asset account. So on the 9th, that's really, sorry, it's so small. There's a $6,000 debit to my accounts receivable. And I need to offset that with a $6,000 credit to service revenue. So on 7/9, I'll also show the $6,000 credit to service revenue, and I'm done posting that. Lastly, I have the 24th, I have a $4,000 credit to cash. So again, I know it's hard to read. I'll put the date in as small as I can. And again, this is another debit to cash. So I'm going to put $4,000 debit here. And this is a credit for that date, 7/24, on the accounts receivable side, $4,000 credits here. So this is basically posting in a nutshell. Of course, after we do post, we can actually tell what the balances are, right? Cash has two debits, so you add them together, $34,000 debit balance in cash. Accounts receivable has $6,000 on the debit side and $4,000 on the credit side. So the balance in accounts receivable would be a $2,000 debit balance because the accounts receivable as an asset, the debit side is larger than the credit side. The balance is on the debit side. Common stock has a $30,000 credit balance. Service revenue has a $6,000 credit balance. So this is basically what you're going to be doing for posting. Questions?